My name's Charlie Viola. I'm one of the founders of Viola Private Wealth. So we manage about just over $3 billion of assets for high net wealth individuals, private clients, some small family offices, some small institutional investors. We manage money across all of the asset classes. We're pretty well known in the market for taking a big allocation to private markets. Public markets are still really important. They still punch out income. They still, sort of generate good earnings growth for clients. But we're a big believer in that private market space. And as a result, we like helping educate both our clients, but also the industry and other advisors as to how to use this space and get the best for their clients.
Presenting that to clients?
Look, I think once upon a time, the public market investment was the vast majority of what everybody did. So as we started to get bigger and bigger clients, and as we started to get more sophisticated clients, what we probably found is there's only so many CBA and BHP shares that you can buy for them. These guys were looking for exposures that were not correlated to things that they did every day. We had lots of investment bankers, but also they wanted to see different and interesting investments. So what we found is that we needed to work harder in terms of how we thought about asset allocation, how we thought about investing their money. So we were a reasonably early mover on the private credit space, where we started working with a number of kind of boutique fund managers and family offices, primarily in the debt space. The debt space turned into the equity space, and then absolutely the shift over the last 10 years, 5 years, probably more like 5 years, has been this real sort of democratization of the private market space. Once upon a time, investing in private markets, so venture capital, private equity, infrastructure, private credit, private debt, was really a place for a different type of investor. It was an institutional space. You needed to have big ticket sizes. What we've seen over the last 5 years or so is lots of players come to the table in this kind of private market space, where we can take exposure to these types of assets for much lower kind of ticket sizes. So it enables us to build better portfolios, generate revenue through the cycle, have all-weather portfolios, as we kind of talk about, and generating a return regardless of the kind of macroeconomic environment at the time. So we take the view that we think returns will be better over the next 15 or 20 years because we've got a much larger breadth of assets to now access. There's way more information out there about them, and a lot of these assets now have been heavily distilled by some really good players in the market. So the reality is if all you were doing is buying ASX 200 shares and some bonds, you weren't adding a lot of value to your client. So it was really about making sure that we could generate their returns in different ways and not have all of their money being susceptible to the exact same risks. And like I said, I don't know that we did it absolutely on purpose. I don't know that we had any grand plan to be a business that did lots of the kind of private market space, but our clients kind of demanded it, which means that we demanded it of ourselves to become educated around that stuff, and then make sure that we built a due diligence process to make sure we were keeping clients' money safe. In private equity and VC especially, where in those funds where you're fundamentally backing the jockey, you're fundamentally backing the manager's ability to find opportunities, work through those opportunities, and then get them to an exit, manager selection becomes so incredibly important. So we're big ones for probably two things. One is diversity. We want to make sure that clients have got exposure to different asset classes, and the other one is asset quality. So we, like everybody, want to make sure that we're picking up on thematics. We want to make sure we're positioning our clients with parts of their portfolio to pick up where thematics are sort of taking over. AI is the really easy example to use right now. What we've tried to do is go and find the avenues and the funds that allow us to do it. So we're an investor in the Stepstone Fund, which gives us exposure to OpenAI and SpaceX, etc. All of which are really interesting from a client perspective. The challenge then is just making sure we size how much of the client's money we put into that appropriately. We want to be rewarded for the risk, but we also don't want to over apex the risk that we're taking. What we want to do in those sort of scenarios is find the managers who are experts in that space. So we're an investor in the angels funds, and we've been an investor over a long period of time in the sidecars and the funds.
Okay.
So, we want to find the experts in that space, because the reality is I know lots of things about lots of investments. I can read balance sheets and, I'm really good on the investment analysis stuff and nowhere near as good as our CIO, Daniel. But the reality is I'm not a tech expert. I don't really know, where the earnings are going to go or what the subscription numbers might look like over time. We've got to find the experts. And the best way to find the experts is find the funds who are literally putting dollars out the door to this stuff. So, we will take exposure. We do believe in it. The other benefit we have in Australia is that it's heavily incentivised. So, the tax effective nature of those early startup concessions mean that, there's lots of capital that flows in, and it gives a lot of these groups a real opportunity to kind of bootstrap themselves with, some sort of regulatory and government assistance, which we actually think is really important. Those opportunities end up with people like us because, clients trust us and they believe in our process and they trust our ability to kind of be completely objective in terms of, the analysis that we do around the underlying fund. So, the Angels Fund is an example, and said, do you mind having a look at this? Some guys I know are investing in it, and I wouldn't mind putting some money in it. We do the usual due diligence that we would do for any fund that we would put any client monies into. So, we want to understand process. We want to understand where opportunities come from. We want to understand, what position you take in the company. We want to understand whether or not you've got controlling positions, board seats, and then we want to understand how you're actually going to get the line of sight to exit. And once we do that, and then we understand the sector that you're investing in, and make sure that we're comfortable with that, then we'll size that opportunity into the client's portfolio at an appropriate level. The nature of PE funds and venture capital funds, especially smaller market cap funds, or smaller where the enterprise value of the underlying company is smaller, you have the feature and default all at the same time. You're not getting the mark to market, which means that when equity markets are roaring their heads off, people are looking at the returns on those through the cycle or through the hold period and thinking, well, shit, they haven't actually done anything, or my dollar's still only worth $1, or in fact my dollar's only worth 95 cents after the fees have come out. That's not doing anything. But the feature to that is that you're not worrying about what the volatility is doing. You're not worrying about whether or not, the impact of a tech sell-off, or, insurance brokers being disrupted by AI, or whatever it is that's kind of, rocking the market, or whatever market sentiment is impacting prices today. It's not. What you've got is you've got some really smart people who have gone and invested in what they think are really good quality businesses with a business plan to an outcome, and everything else is just noise until the outcome actually occurs. So we like that. We work really hard to educate the clients to stop comparing your kind of point-to-point PE and VC returns with the day-to-day mark-to-market returns that you're getting on equity markets. In the public market, listed companies are obviously valued every moment of every day. So you're fundamentally getting an understanding as to what that company's worth, because it's listed on a ticker screen and you can see it. With private equity and VC, what you're investing in is the manager finding good quality businesses to go and invest in. And we explain that to clients. We say it very clearly to clients. You're backing someone to go and pick, in the sector that they believe that they're an expert in, to go and pick the best possible company to generate a return out of the capital that they give to that company. The outcome isn't overnight. It takes a period of time. And then it takes somebody else seeing that as valuable before they'll pay for it. You're not going to see a mark-to-market return in the short term, and you've got to zoom out on this stuff. Okay, we take an endowment style view. So we take a Harvard, Yale type view in terms of how we build out portfolios. If you look at how those major endowment portfolios have been invested over time, 45% of it is in private equity and VC, because they take a long-term view in terms of good quality businesses that will grow over time. We want them to think about that part of their portfolio as producing the best return in the portfolio over a long term. Our private market allocation is, depending upon the client, will be anywhere from sort of 35 to 45% across all the various different types of private market allocations. So private debt, private credit, infrastructure, VC, PE. PE and VC will be anywhere from sort of 8 to 15% of a total client portfolio. So whether it's, pure like startup, pre-revenue seed capital, or whether it's large end buyout, It's all considered private capital, right? But it's a spectrum, and it all has very different risk profile. We do want to be invested across that spectrum. So we don't want to use up all our bag either down there or kind of up there. So, the time to exit is different, the return expectation is different, and fundamentally the risk is different. So we want to make sure that we're sort of blending client portfolios in the right way. We just want to back the absolute best jockeys in the market that we can find. Once upon a time, it was much harder to gain these types of exposures. It's now very easy, and as I said, it's been heavily democratized. Those funds that have come down to the private wealth level and allow us in at 100 or 150 or 250 enables us to get real diversity into client portfolios and access to some pretty cool stuff. So what we've probably seen over the last 10 years or so with groups like VentureCrowd and iPartners is that continued democratization of the private market space, where you've got these guys going out and finding really good, interesting opportunities and allowing investors for really small amounts of money to take exposure to them. Once upon a time, that just wasn't, that you just weren't able to do that. And people who, lots of people have got lots of access to lots of information, but no ability to go and execute on it. These platforms now give people the opportunity to go and execute on those things with small amounts. It's simple, and they can almost build up their own portfolios of sort of single investment opportunities, knowing that some will do really well and some won't do really well. So, it's fantastic. It's probably almost like, if we think about the fact that 25 years ago in Australia we started having managed funds, which gave people an opportunity to kind of invest in, well-managed kind of diverse funds of domestic and global equities. These platforms now give people the opportunity to almost do the same thing, but in venture, which generally speaking wasn't available to the everyday person previously. So, we're sort of seeing that all of the things that we learned from there, we're now benefiting from. And I think, some of those kind of market-linked, large cap funds have been overtaken by ETFs and what have you, whereas there's still a real place to play in these tech platforms because people want instant access, instant investment, lots of information, ability to log in on their phone, and you're giving them all of that. We've been very well received by the market, and we're very appreciative of that. We work really hard to kind of be sort of client-centric, and ultimately we just want to keep seeing, good clients who want good solutions from us, and we just want to keep delivering good investment outcomes. Our biggest thing always is we'll put the client first, and then the rest will follow. But for us, what that means is we're just going to build really good quality, diverse portfolios, generate revenue through the cycle, and protect their capital sort of best we can.